What happens when one of the world's most important financial markets start to break down? Does money flow into Bitcoin as an alternative traditional finance, or does Bitcoin crash along with stocks, real estate, and other risk assets? The answer is not simple as a bond crisis equals Bitcoin rally. In fact, Bitcoin could fall sharply at the beginning of a bond market crisis. But if that crisis lasts long enough to damage confidence in government debt, currencies, or the financial system itself, Bitcoin could benefit later. In this video, I'm going to explain what a bond crisis is, why it could hurt Bitcoin, and why it could eventually help Bitcoin, and which signals investors should watch. So what is a bond crisis? First, let's define the problem. A bond is essentially a loan. When you buy a government bond, you are lending to the government in exchange for interest and return of your principal later. Bonds are often considered safer than many other investments, but they are not risk-free. Their prices can fall when interest rates rise. That is because newly issued bonds may offer higher interest payments, making older bonds with lower payments less attractive. A bond crisis can develop when investors rapidly lose confidence in government debt, inflation control, economic stability, or the ability of borrowers to meet their obligations. It can also appear when yields rise so quickly that banks, pension funds, governments, and businesses come under serious pressure. The important point is that the bond market is enormous and deeply connected to the rest of the economy. Higher yields can raise borrowing costs for governments, companies, and even households. That can slow investment, reduce hiring, and put pressure on financial markets. So why can Bitcoin crash first? Now let's look at the short-term danger for Bitcoin. During a sudden financial shock, investors often do not immediately search for the most innovative asset. They search for liquidity. In plain English, investors want cash. If bond prices are falling and yields are rising, financial institutions may face losses or margin calls. Investors may sell stocks, currency, and other volatile holdings to raise money quickly. Bitcoin is highly liquid and trades around the clock, so it can become one of the first assets sold. This is one reason Bitcoin can behave differently from its long-term narrative. Many supporters view it as an alternative to the traditional financial system, but in the short run, Bitcoin is widely treated as a risk asset. When investors become nervous, they can correlate that matter more than a long-term story. Higher interest rates can create another challenge. When investors can earn more income for relatively low risk assets, they become less willing to hold fluctuating investments. Bitcoin has to compete for capital, and higher yields can make that competition more difficult. A bond crisis can also produce forced selling. If leveraged traders receive margin calls, they have to sell Bitcoin regardless of whatever they believe that is the future. They can create a feedback loop. Prices fall, liquidations increase, and more selling pushes prices lower. So in the first stage of a crisis, Bitcoin may not act like a safe haven. It may act like a source of cash. Why Bitcoin could rise later? The story doesn't necessarily end with Bitcoin falling. The long-term reaction depends on how governments and central banks respond to the crisis. If a bond crisis is connected to high inflation, unsustainable debt, or declining confidence in the currency, investors may begin searching for assets outside the traditional system. That can include commodities, foreign exchanges, real estate, gold, and Bitcoin, and also foreign currencies. Bitcoin's appeal in this scenario comes from limited supply. and its independence from any single government or bank. Supporters argue that this is what's make it attractive when people that worry policymakers will create more money, weaken the currency, or use inflation to reduce the real burden of debt. But this is where we need to be precise. Bitcoin is not automatically protected from inflation, debt problems, or market crashes. Its prices can fall during those events. The argument is that prolonged distrust in traditional finance can increase demand over time. Not that Bitcoin must rise immediately. Think it as a two-stage scenario. Stage 1 is the liquidity shock. Investors sell what they can. Stage 2 is the confidence debate. Investors ask whether the traditional system is stable enough to trust in Bitcoin's performance, and could be very different in those two stages. Now, here's the 5 signals to watch. Number 1, real interest rates. Real rates measure what investors earn after accounting for inflation. If real yields remain attractive, capital may stay in bonds. If inflation erodes those returns, alternatives may become more appealing. Number 2, the strength of the US dollar. A stronger dollar can put pressure on Bitcoin because global investors often need dollars during periods of stress. A weaker dollar may support demand for scarcity or alternative assets, although the relationship is not perfect. Number 3, liquidity. Watch whether money is leaving the markets or entering them. Central bank policy, government spending, lending conditions, financial stress can all influence liquidity. More liquidity often supports risk assets, while liquidity squeeze can pressure them. Number 5, the policy response. If officials respond to a bond market shock with emergency lending, intervention, stimulus, or monetary expansion, markets may react quickly. The response could initially support Bitcoin or produce a rush for cash before any recovery begins. Now, what this means for businesses and workers. This issue is not about bond trading markets, about trading markets. Bond market stress can affect the real economy, including hiring, compensation, retirement savings, and business investments. When borrowing costs rise, companies may delay expansion, reduce spending, or become more selective about hiring. Businesses connected to finance, technology, and cryptocurrency may also face pressure to strengthen risk management and compliance. At the same time, a more regulated digital asset industry could create demand for professionals in cybersecurity, accounting, legal services, compliance, financial analysts, and blockchain infrastructure. For workers and business owners, the practical lesson is not to make a career or investment decision based on one Bitcoin headline. The better approach is to understand how interest rates, liquidity, regulation, and financial confidence affect the industry. So is Bitcoin going higher or is it crashing? And that's the main question that we have to answer. And I'm going to give you the most honest answer. And the honest answer is potentially both, but at different points in the crisis. A sudden bond market shock could push Bitcoin lower as investors raise cash, reduce risk. A prolonged crisis that damages confidence in government debt or fiat currency could strengthen Bitcoin's long-term appeal. Bitcoin's direction would depend on details. Is the crisis caused by inflation, a recession, or banking problem, or a loss of confidence in government finances? Are policymakers tightening liquidity or injecting it? Are investors seeking safety or alternatives for money or investments? This is why there's no simple rule that saying bad news for bonds is automatically good news for Bitcoin. Markets are driven by liquidity, expectations, positioning, and confidence, not just by one headline. So the conclusion of this whole video is that I want to share with you that Bitcoin may be an alternative to traditional financial system, but it is connected to that system. In a sudden crisis, that connection can hurt. Over a long period, distrust in the system could hurt Bitcoin's investment narrative. The key lesson is to watch the sequences. First, liquidity, then policy, and finally, confidence. The order of those events may matter more than the headline itself. Just giving you some educational insights. This is not investments. I'm not telling you what to invest in or what not. I'm just letting you know in regards to what can cause Bitcoin to crash and what can't. And sometimes, what you think will cause it, Bitcoin might rise or it might not rise. So invest in with your own knowledge and understanding. If you want more insights to cryptocurrencies, to Bitcoin, and also employment through this new AI age, please go and subscribe to the Human Capital newsletter, where it keeps you abreast on the new technology and the new financial infrastructure.